Hi everybody, it's Peter Schiff. This is Friday, October 29th, 2010. I'm recording this video blog from my hotel room in New Orleans, where I am attending and speaking at the New Orleans Investment Conference. Always a good time at this particular event, but I am still paying attention to what's happening in the markets. This week was, I guess, pretty quiet for the stock market. It was basically flat. I think the Dow Jones was off maybe 10 or 20 points. I'm not sure exactly. The dollar resumed its trend of weekly declines. The dollar index was down. Dollar index closed, I think, just below 77.20. Of particular note was the Japanese yen, which closed with a new all-time record high, both on a daily basis, on a weekly basis, and on a monthly basis. So that is a very strong move technically for the Japanese yen. Now, it didn't make a record high on an intraday basis. That might happen next week, but certainly closing on both the daily, weekly, and monthly charts, it is a record high for the yen, a record low for the US dollar. Also on the week, the New Zealand dollar, I hit a new 52-week high. This is it's not a record all time, but it's getting close. And I think the standout on the day or on the week was silver. I mean, silver rocketed about 75 cents an ounce today, closing at a new multi-year high, 30-year high or something like that, at over $24 an ounce. The news on the day was that Sprott Asset Management is going to be doing a $500 million IPO with a silver trust that will trade both in the U.S. and Canada. Obviously, if they're going to put another $500 million into silver, that increases demand for silver, so the price is rising. But it shows that there is growing institutional demand to hold physical precious metals, both gold and silver. And the reason for that is that the government continues to debase our money to try to artificially stimulate our economy by trying to revive a phony economy. More proof of the phony economy being revived was offered today. We got the GDP numbers for the third quarter, and the economy grew, in quotes, by 2%. But what powered the 2% growth was the biggest increase in consumer spending in over 4 years. All that means is this growth is simply borrowed from the future, that we're getting growth today at the expense of future growth, because consumption isn't growth. We're spending money. And where are consumers getting that money? It's being created. It's being borrowed. It's being printed. And so all this Fed has succeeded in doing with its stimulus is get consumers to spend money that the economy desperately needs them to save. Remember, as I said over and over, that consumers reducing their spending is not the problem. It is a necessary part of the cure. But the government, through monetary and fiscal policy, is preventing the cure while exacerbating the disease. And that is exactly what we learned from this GDP report. The economy did not grow because of increased capital investment, because of increased production. It grew because consumers spent more borrowed money. And now, because of that, the economy is in weaker shape, because now we are in a bigger hole that we ultimately need to climb out of. And so future spending needs to be reduced that much more, not only to make up for our excess spending of the past, but to make up for the continuation of the excess spending, which is a direct result of Fed and government policy. Also, we're going to find out, I think, next week about the size of this, QE2, quantitative easing 2. I wrote a commentary about QE2 that is available today on the Europac website, europac.net. So go there and check it out. It's a good column. But the problem, again, with the QE2 is it's simply designed to sustain or try to reinflate a bubble economy, and so it is doomed to fail. That's why I'm not calling it the QE2. I'm calling it the Titanic. And it's not going to be the last. It's going to be QE3, QE4, QE5, because none of the quantitative easings can actually work. It's all it can do is try to delay the problems, but in delaying them, they exacerbate them because it interferes with the cure while worsening the disease. And I had been thinking about another ulterior motive for QE2 because, the government is pretending, or the Fed is pretending, that the reason for QE2 is because we have to stimulate the economy, because we have to create employment. And first of all, back in the day, they didn't call it QE2. They called it debt monetization, which is what it is, which again is another name for inflation. But the Fed doesn't want to say we have an inflation policy, so they're calling it quantitative easing to make it go down smoother with the public or with investors. But I'm thinking that the real reason for this QE2, because maybe the Fed knows that it's not going to help the economy, it's not going to create jobs, but if international demand for dollars is waning and dollar-denominated debt, and we're seeing that in the Treasury bond market. I mean, Treasury bond prices were up today, but they were down pretty substantially on the week, and we broke through some key trend lines in both the 10 and the 30-year. So I think we could see some weakness in the bond market, and I think the reason that the Fed wants to buy Treasuries, it's not because they think it's going to help the economy. It's because they want to replace the demand that no longer exists in the marketplace. They want to be the buyer of last resort, but they don't want to create a panic. So if they can first set the stage for debt monetization by saying, this is part of our plan to stimulate the economy, we want to go out and buy treasuries, then when the U.S. government can't find buyers at its auctions for its securities, and then the Fed ends up buying, it's not going to spark any panic where people realize that the reason that they say, oh, the Fed is buying because the Treasury can't find any buyers, and all of a sudden they perceive a funding problem with the U.S. debt, they're just going to say, oh, it's quantitative easing. The Fed is buying because that's part of their plan. So now the Fed diffuses that potential problem by acting as if this is what they wanted to do. But the reality is they don't really want to buy these bonds. Their backs are to the wall. They have to buy the bonds because nobody else will. And so if the Fed didn't step up and monetize the debt, bond prices would plunge and interest rates would soar. That, I think, is the real reason for quantitative easing, and nobody wants to point it out. Meanwhile, if I don't get a chance to blog about it, next week we've got the election coming up on Tuesday. It's always possible that if we do get a strong showing by the Republicans, maybe there'll be some kind of rally off of that. I think there are a lot of hopes being pinned on a Republican takeover, certainly of the House, maybe of the Senate, to put the brakes on the Obama administration and maybe to tackle the runaway deficit spending. Unfortunately, I don't think the political will or even understanding of economics is there among the Republicans currently in Congress, or most of those that are likely to go to Congress. Yeah, there's a couple of exceptions, but probably not enough to actually alter the course that we're on. So I think any hopes of fiscal responsibility coming out of a Republican-controlled Congress are going to be dashed. There might be some kind of market-led rally initially, but I would expect it to fade for that reason. Whether or not there's going to be a rally in the dollar if the Republicans come in, I doubt it. Certainly if stocks rally, it would break with current trends if the dollar also rallied, since stocks seem to only rally when the dollar falls. So I don't think we're going to get any kind of big dollar boost out of a Republican victory. I don't think there's going to be a big sell-off in gold. But if there is some kind of knee-jerk flight from gold, or there is a buying of the dollar because of the perception that the Republicans are going to solve these problems, it's going to be short-lived, because very quickly people will realize, I don't think the Republicans are going to want to do anything. I don't think they want to take the chance of doing something, even if it's long-term positive, that might make the situation worse in the short run. Because in order to get better, things are going to have to get worse first. There's no way to cure this disease without swallowing some bitter-tasting medicine, and the Republicans have no stomach for that. They're thinking, of course, about 2012. They want to try to take the White House. They want to increase their majority. If they don't get the Senate this time, they're going to have their eyes on it. So the last thing they want to do is get blamed for the economy getting worse. So unfortunately, I think the Republicans in Congress are going to be just as reckless and just as irresponsible as any of the Democrats that they're replacing. Maybe it'll be a little bit more difficult for Obama to raise taxes, at least legitimate taxes, but I don't see any real cuts in government spending, any meaningful reforms coming out of this Congress. So in other words, I might be voting Republican in this election, but I'm not selling any of my gold. I'm not altering my investment decisions based on that outcome. Anyway, maybe I'm wrong, but I doubt it. Anyway, that's it for today. Have a great weekend, everybody, and enjoy Halloween. And I'll be back again next week when I return to Connecticut. Take care.